Okay, so today I want to talk to you about something that has absolutely nothing to do with this class at all. Okay? I want to run an experiment that I want you to participate in, and so I'm going to use this class to explain to you how it would work. Right? So what I'm going to talk about today is things called prediction markets. So you might have heard of some of these. And what prediction markets are, they're basically online betting exchanges. I mean, to be honest, Americans talk about them in ways different to the way we do. I mean, the biggest online prediction market we know off the top of our tongue is Paddy Power, like. I mean, and people, make predictions about who's going to win what, and they get, Okay. So, but you can also run a prediction market to find out other things. Okay, so they're speculative markets that allow people to bet on the outcome of future events, and you can use real money or play money, and they're considered a very good way of getting opinions from people. So if you were to say to someone, who do you think will win the match next week with Munster? Okay, and lots of people might say Munster. If you said to them, would you bet €50 on it? Well, then, loyalty starts to waver a bit. It's like, go Munster, but I'm keeping my hand in my, keep my money in my pocket maybe, depending on the scenario. So when you ask people to put money on it, you're getting not just their opinion, but you're also getting an assessment of their confidence. Because if they're very confident, they might put lots of money on it. If they're not very confident, well then they might not put so much money. So those are concepts I think that are very familiar to us. To Americans they need explaining because gambling is illegal and wrong and all that sort of stuff. So they're not so familiar with gambling. But it turns out, for example, that prediction markets can be very accurate. Now again, we don't need to do lots of research in Ireland to know that Paddy Power is almost never wrong. Do you mean the money is generally right. Now the most famous prediction market is the Iowa Electronic Markets, and that's run by the University of Iowa. And that's been running for a very long time now. And people play with real money, but just a small amount. You can invest like $500 and then go from there. And people bet on the outcome of elections. So people would bet now on whether Obama will win the upcoming election or not. And it turns out that it's been very, very accurate. Typically, it's been as accurate or more accurate than any other polling method. So people are very interested in that kind of thing. So if you look here now, you can see the piece I've highlighted there in blue. That tells us, for example, that this market thinks that Obama has a 53% chance of winning the election, which I'm surprised it's so low. Like I thought it would be in the 60s or something, So this market thinks Obama only has a 53% chance. Yes?
Can you stick that thing down?
What thing?
The projector.
Just there, the desktop.
Oh, I'm not sure that I can actually. No, someone shouldn't kill themselves as well then. Okay. Now, there we go. File under irony. Puts the projector out of the way, then kills himself on the chair. Okay. No. But this is rating Obama's chances at about 53%. Okay, which I think it's easy money, but then again, I'm not au fait with American politics. So if you thought that Obama had a better than 53% chance of winning, you might buy some of those shares. Okay, now another very famous one is the Hollywood Stock Exchange, and that's a play money exchange where you can buy and sell shares in actors and directors and movie projects and stuff. So that can give Hollywood studio executives an idea of like which stars are bankable and which ones aren't. And you use play money. So to give you an example, I've got whatever, I've worked about $3 million. I didn't make, I don't get to go to the cinema much anymore, so I don't know what's coming and what's going. I bought Natalie Portman shares like years and years and years ago when she was a nobody. And then I sold them just before Black Swan. So I could have made loads of money. So I've just been playing with buying Irish celebrities or UK celebrities. I had loads of Colin Farrell shares because nobody wanted them for a while. And then when Total Recall came out, they shot way up, so I sold them. But normally I would have had Colin Farrell shares. So like these are just virtual stocks in celebrities, and if they're kind of on the way up, their price might go up. If they're on the way down, gives you some sort of idea. I'm sure the very neurotic ones are logging in every day to see how much they're worth. That's good fun, and it's actually serious business. Like this site makes money from Hollywood by selling them the information. So also you might have a proposal. You might have there's going to be a movie, starring Colin Farrell and this person and this person and this person, and it's going to be a science fiction directed by whatever, and this is going to be the writer. Kind of, what do you think of that, guys? And like, if the price of that goes way up, well, then they might go away and actually make it. If it's looking like nobody's going to be interested, they mightn't bother. So they can use all that information. This is Cillian Murphy's stock price. He's gone way down now lately. So I lost money on him, but out of loyalty for. Well, actually, no. To tell a lie, he's up slightly now. It's yesterday, but this is the idea anyway. You can see what projects, what movies are kind of people thinking are going to be good. So, and you see, if you own one of the movie shares, you actually get money then back based on how much money the movie makes. So if the movie makes loads of money, like in the first week or so, then you're going to get a dividend. There's going to be a profit. So Guillermo del Toro has made a Pinocchio movie, which seemingly was up a bit yesterday. Avatar 2 is up a small bit. At the bottom of the scale, Taken 2 is people are selling that. So who knows? Okay, no. Intrade then is a commercial betting exchange for non-sports events, and that's a very famous one. In terms of online gambling, and well, let's not call it gambling. In terms of online prediction markets or online futures markets, Ireland is actually probably the Las Vegas of the world. So Intrade is in Dublin, and they do betting on non-sports events with real money. So you could, if you wanted, you could bet $500 on the Iowa exchange on Obama to win. You could probably bet $5,000 here on Obama to win, and they'll happily take your money. So they're giving Barack Obama a 66.8 chance of winning on the same day the Iowa Electronic Exchange was only giving him was it 54 or something? 53.
Iowa is a southern state and he's not like that popular.
No, it's not how he's going to do in Iowa. It's how he's going to do, whether he's going to win the election or not. Do you know? So I want to plow through this now. So this is Obama's stock price on Intrade. So he's been, he has peaks and troughs and stuff. You might find here that peak towards the end was the debate last week, I think. It's interesting, most Americans think he lost that, whereas most people putting money on the table in Dublin, and these aren't people from Dublin, I mean, this is probably one of the few places you could legally bet lots of money on the election. The non-American money anyway seems to think, he had something like a 70-odd% chance of winning. Interestingly, this does open up opportunities for what's called arbitrage, where you buy in one market and sell in the other. I mean, basically, if Obama has, well, let me say this right now. You could bet on both of them and win money either way. Do you know what I mean? If you bet on Iowa, on one guy, and the other one in Dublin and Obama, you could theoretically win them both. No, you could not. No, you couldn't win on both, but you could win overall. Do you know what I mean? Because you're getting very different prices. But that's complicated. Don't want to go into that. No. So organizations then can run their own prediction markets, and some companies have had a lot of success with that. So HP used prediction markets to predict sales figures for printers and stuff. So they had like various methods for forecasting how many printers they're going to sell, and they got numbers from that. But then when they said to people, look, here's some pretend money, bet on how much you think we're going to sell, and then when we know how much we've sold, you either win or not. And then that was a very different kettle of fish. They got very different answers. When people were kind of playing for prizes, you know, they made different decisions. And so they've done a lot of work on that. And Google has done things like, you know, will this product finish on time? You know, how many people are going to sign up for Gmail, whatever, stuff like that. So it's a way of getting information from your workforce or from your employees or from your customers, you know, and getting them to actually tell you what they think. Do you know, so, you know, if Ronan O'Gara took a break from training there now and came in here and asked us, you know, how many people think Munster are going to win, you know, we'd all say, yeah, you know, definitely, and he'd get 100%, you know, Munster's going to win. But if he actually asked you for cash, you know, he might get a different response. You know? But maybe not. No. Now the markets work. There's kind of two different ways the predictions work, and the way they give you their money. Okay. One way, and this would be like in a yes or no situation, like in the Munster winning or Obama winning type scenario, where you buy a share in an event for a certain price, and then if the event happens, the share is worth $100 at the end, and if the event doesn't happen, it's worth nothing. So if you buy a Democrat share and the Democrats win the election, then each share will be worth $100 if they win. So if you buy a Democrat share for $70, you're going to get a profit of $30 if the Democrats win. Because if they lose, you've lost $70 per share. So that's a typical kind of contract. Now, what you can do in a prediction market, which what you can't do with Paddy Power, let's say, for example, you bought shares. Let's say you went into Paddy Power and you bet on Munster to win. Okay, you bet €100 on Munster to win at whatever odds he was giving you. Okay, and you did that like months ago. And then closer to the time, the price has gone way up, right? Well, you could wait, and if Munster wins, go into Paddy Power and get your money back. But you could maybe stand outside Paddy Power, you know, and if somebody was going to go in to bet €100 on Munster, you could say, well, look, I'll sell you my docket, right? So that person gets what they want. They get Munster to win at the price they want. But you've got your money now. Do you know? There's something you can't typically do with Paddy Power, is that you can sell your shares as well. So that can be a way to make money. So if you buy a share in Democrats for $70 and the price goes up to $80, well, you could wait, and if the Democrats win, you'll make your $30. Or you could just sell it to someone who's willing to pay $80 and take your $10. That's the proverbial bird in the hand instead of two in the bush. So as the price goes up and down, you can buy and sell. Generally, we take then the price to be the market's estimate of the probability. So if you can buy a share for $100, if you're buying shares for $70 and they're going to pay $100 in the event of a win, well, it would only make sense for you to do that if you thought the probability of that happening was 70% or higher. Like, if you thought there was only a 50% chance of winning, well, then you wouldn't pay $70. It wouldn't make sense. That's not a proposition that would be a strategy that would be profitable for you. Now, some markets offer pairs of contracts where you can bet on one thing or the other, but the prices may be interconnected. I mean, if you're betting, if people are paying $65, people think there's a 65% chance that Obama's going to win. Well, obviously then, those same people must only think there's only a 35% chance of the other guy winning. So the prices may be linked in some way. Now, this is where it gets slightly complicated, okay? So for yes or no questions, typically you buy the share, and if it happens, you win 100, well, the share is worth 100. If it doesn't happen, the share is worth nothing. Some contracts don't pay out 100. They pay out a value proportional to the value that's trying to be predicted. So if you're trying to predict a value, you have different kinds of contracts. So you might say, for example, how many goals will Barcelona score? And you might say that those shares, if you have a share in Barcelona, for every goal they score in that match, that share is going to be worth $20. So the price you might be prepared to pay for that share then would give some indication of your assessment of the probability of how much they're going to score. So if Barça scores nothing, they don't score any goals, the share is worth nothing. If Barça scores 4 goals, then each share is worth $80. So depending then, I mean, there's no way you would pay, $120 for a share, because they'd have to get 6 goals before you'd even break even. Now, you might say, well, I think they're going to win and I think they're going to hammer them, so I'd be happily pay $30 a share, which if they score 2 goals, I'll make money. So price of $45 then would mean that the market thinks that Barça is going to get, chances are they'll get more than 2 goals. A price of $5 means that the market thinks maybe that they're not going to score any goals. That's kind of the idea. So some contracts will pay 100, some will pay a particular value. When you're trying to predict a number, for example, if you're trying to predict a percentage, which is what we'll be doing for some of the experiments, then the contract will be worth what the percentage turns out to be. So if you buy something for $50 and the percentage turns out to be 70, then that contract will be worth 70, so you make a profit of 20. No. So they work like stock exchanges. So I'm going to explain 1 or 2 things about stock markets. There's one very complicated thing actually, but we'll see how we go. So one way to make money is you basically buy low and sell high. So if you buy something when it's cheap, when the price goes up, you sell it. You don't actually care what the final outcome is. You've got your money now. So if you buy a share at $26 and you can find someone who's willing to take it off your hands for $52 in week 7, well, then you can just take your profit there and let them worry about whether it's actually going to happen or not. Now, they'd only do that if it seems an attractive option to them. So that makes a profit irrespective of the final payout. You just cash in, or cash out it's calling, at that stage. Okay? So if you think the share price is too low, so if you think the price is going to go up, or you think that the price that's being asked now is good value because the outcome is going to happen and it's going to be worth more than they're asking now, then you would buy shares. Now, the price you pay is very important. Like, suppose Barcelona were playing Celtic, which is going to happen fairly soon. You might say, well, I really fancy Barcelona's chances against Celtic. But if lots of other people also do that, they may have pushed the price up to Barcelona, for Barcelona, up to $95. So they're saying there's a 95% chance that Barcelona is going to win. And maybe there's a 4% chance of a draw and only 1% chance of Celtic winning. Now, I too think Barcelona would hammer Celtic. But at the same time, if I buy a share in Celtic for $1 and they win, it's going to be worth $100. That's a sweet enough deal. I still think Barcelona is going to win, but I think the price is way too high. I wouldn't be 95% sure Barcelona is going to win. So it might actually be worth a gamble at that price. Do you mean if Paddy Power was offering 100 to 1 on Celtic to win, you might think, well, that's worth a few bob, like. Do you know? I still think Barcelona is going to win, but there is an outside chance, and at that price, you know, it might be a good gamble. So the price you pay is important. It's not just about what you think is going to happen. It's about whether you think the market's estimate of what's going to happen is accurate. So even if you think Barcelona would beat Celtic, you know, if you bet $10 there, that could turn into $1,000. Do you know? That's a reasonable enough offer, I think, that one might take. Now, if it was 40-60, maybe there's no great money to be made there. So the price is important. If you think the price of a share is too high, then you should sell shares. So if you have shares, you should sell them. That's where it gets a little bit tricky. Short selling is when you sell shares that you don't actually own, which happens a lot. So if you think the current probability estimate is too high, then you can bet against an outcome by selling short. So obviously if you have shares, and so if you had shares in Barcelona and then, you know, there's a bus crash and a couple of them break their legs, you know, you might think, okay, you know, all of a sudden their chances of winning aren't so high. You might decide to sell your shares. But with short selling, even if you don't own shares, you can sell shares. So basically you bet against an outcome. Or when people are short selling against a company, they bet against the company's stock price. So when you do that, you must have money to cover your losses in the event of a lot, you know, in case you're wrong. In reality, what you're doing when you're short selling, this will make your head explode now, you're borrowing shares, selling them, with the hope of the price dropping, so when you go to give back the shares, you'll make money. But that's not really important. You can bet for an event or you can bet against it. Okay, so that's a bit complicated, right? But what's handy is some sites, and the one we're going to use, makes it easier for you to express your opinion without worrying about, you know, am I selling short? Have I money to cover this? Blah, blah, blah. So, for example, on this Intrade site, okay, you can either bet for Obama or you can bet against him. Doesn't matter whether you own shares in Obama already or not. There's no talk of short selling or whatever. You just pick one or the other. So 66.8% chance. If you think he's like dead cert, you might take that offer and you might bet money on him. So if you, for every $67 you spend on a share, if he wins, you'll be paid back $100. So you might make a profit of around $30 per share. Ask me something?
Betting against him, why wouldn't you just bet for Romney?
Well, that's the thing. Why wouldn't you just bet for Romney? You know, when there's a pair of shares like that, you could bet for Obama, or you could bet for Romney rather than betting against Obama. Now, the way they've done this, they actually have two separate contracts, and they do probably modify the prices. But you could imagine a rather bizarre scenario where Obama had a share price of 55% or $55, and Romney had a share price of $55. In which case you couldn't lose. You just bet on both of them, you know. Now, sites like this, they do tweak the numbers so that doesn't happen typically. But theoretically, that could happen in a system where there's two separate contracts. Okay? But I imagine when you're betting against Obama, you're actually betting for Romney. But the mechanics of it may be slightly different. Even if you look in Iowa, the prices don't add up to 100%. They don't add up to $100 because they're two separate contracts. But that's a very good question. This is a question then of how you design your markets. And of course, it's more complicated if it's football. If it's soccer, because it could be win, lose, or draw. No. So this Inkling site here is the one we're going to use. And this is fairly straightforward because what happens is okay, I'll tell you that in a second again, sorry. So if you buy a lot of shares, you can actually run out of money. You might have all your money tied up in different options. So let's say you've bought lots of Barcelona shares, you've bought lots of Obama shares, whatever. And then a really sweet deal comes up. And you're thinking, I can't believe that price. I really want to take something at that price. But you've got no money. Well, you can sell some of the shares you have, hopefully for a profit. And then that'll put more cash in the bank. And then you can go on to trade other things. So you always have the option of selling trading in there's buying and selling because you want to push the price up and down. But there's also just, can I take my money back now? Can I turn my positions into cash? And hopefully make a profit when you do that. Then you can trade your cash in other markets. So this is what I'm going to get you guys to do, which I think is pretty freaky, is I want you guys to predict what the pass rate for this module is going to be. So there's roughly 40 of you. How many of you are going to pass this module on the first go? And also I want you to predict what the attendance rate is going to be up to week 10, including week 10. Usually week 11, week 12 kind of things start falling apart with presentations and assignments and stuff. So, looking around here now, the attendance rate is pretty high, And just from walking around the labs, I get the feeling the pass rate is going to be pretty high. So you might decide you want to buy, up to maybe 80% or something. What I'm wondering then, what might happen is that after you have your first exam, if the price drops from 80 to 30, that would probably tell me that, maybe now they're a bit freaked out by that exam. Maybe that exam didn't go very well. So everybody get the idea? So it could be interesting. It could be very strange. We'll see what happens. What's really interesting is everyone else taking this module is going to do the same. And you can bet on them as well. So if we're going to break you up into groups, so this is one group, irrespective of whether you're in DWeb or ITM. But you're going to be in different groups. So if the share price for one class is really, really high, and the share price for another group is really, really low, I'm not sure what it tells us, but it certainly tells us something interesting is happening. Really get the idea? Now, I've also put in a few other things just so you can get some practice. These contracts won't have yes or no answers, so the contracts will pay out based on the values. So if you buy shares at $50 and there's a pass rate of 80%, then you get your $50 back plus the extra 30. But if you buy at 60 and there's a pass rate of 50%, well then you lose $10 per share. So you want to make sure you buy at the right price. Do you know? But either way, you'll make money by pushing the probability estimate in the right direction. So this website here makes it very easy, really, to make a trade. So the price is starting at 50%, which I think is a bit low. So you could log in fairly soon and push that price up to where you think it should be and maybe make some money. So if you think the pass rate will be higher, as I do, then you should go and buy some of those shares. If you think it's lower, well, then you should bet the price down. This side also, this interface here is nice because it lets you bet a little or bet a lot. So here, if you want to move this price higher, you can bet a small amount and move it up a small bit, or you can bet a large amount and move it up a bit higher. Okay? And your trades will move the price. Now, like I said, every student can trade in every market. So, if you're passing a pub some night before an exam that ITS is doing, and you see them all hanging drunk the night before the exam, you could get out your phone and, start betting against those boys. Okay. Now, participation is voluntary, of course. So I've actually already sent you an email that you can use to sign up. So you'd sign up with this site. It'll probably ask you for username and password and stuff. It deals all with that. I don't know anything about that. You can trade anonymously. And there will be some prizes for people who make money. Now, I haven't got a decent commitment yet on what the prizes would be. I mean, the worst prize would be an iPod Shuffle, but I'm hoping to push that up and get, a few things better. I'll also probably go for several decent prizes rather than, one big super duper mega prize. So like if I had enough money for an iPad, I'd probably buy 3 iPod Touches. Do you know what I mean? But so I don't know what the prize fund will be yet, but there should be fairly decent prizes anyway, Also, for the most part, I think if the more money you win, well, certainly the more money you win, the more likely you are to win a prize. I'm not sure if the prize will go to the person who gets the most money. It turns out there is a way to cheat. So if I see that, then I'll have to distribute the prizes a slightly different way. But anyway, either way, you improve your chances of winning a prize by making more money. Okay? No. So there's 4 groups. Group C is this group. Group R is who would that be now? Well, I know they're Robs, but what class is that? I guess that's DNet and DCOM. Yeah, that's DNet and DCOM. Then there's Group M, which is COM, and Group T, which is ITS. Okay. Let me fix that now. So that's well, I'll do it in a minute. No. Let me show you then. Have we time? We do. Dum. This could take a while. Okay, so just let me show you the website. So you need to sign up by following the instructions in the email that I've sent you, but it's at corkit. So let me just give you a quick example of how it works. Now I put some sporting ones in there as well, just to just for the fun. Okay, so I'm logged in already here now. So the current price for Munster to beat Racing Metro on the 13th of October is $40, which I think is low. you know. So I'm going to buy some of that. I'm actually going to buy, well, I buy a little bit, okay? So, actually I'll buy more than that anyway. No. So, by spending $366 there, I'm going to push the probability up a bit. And if Munster wins, I'm going to make some money. Okay? If I thought they were going to lose, well, you see, even if I thought they were going to lose, it would depend like how sure I was they were going to lose. Do you mean if it was, you know, CIT versus Racing Metro, you know, then that price would be very high, I think. Do you know? So depending on whether you how sure you are. I mean, if, for example, the price was $99, okay? If the market was like absolutely, totally certain that Munster was going to win, even if you thought Munster would win, even if you agreed with the market, it would probably be bad value because you'd be spending $99, and if they won, you'd earn $1 for that $99 investment. It's probably not worth the risk. In fact, even if you thought Munster would win, you should probably bet against them at that price, because you could bet $1, and each dollar you bet could earn an additional $99. So the price is key. But I definitely think this price is too low. I think there's some money to be made here. So there's other questions as well. I can show you where I can show you the list of questions. So here are the questions we have so far. Munster to beat Racing Metro, Dynamo Kiev to beat FC Porto. There's not really many great games coming up. Do you know? Barça to beat Celtic, which we already discussed. Is 80% too high or too low? I think it's about right, like, but I'm biased. Maybe it's too high. Maybe 80% chance of Barça beating Celtic is too high. And then we have all the other ones here. Now, you have the most information about your own group. So, I mean, if you know, for example, that there's 5 people, buddies, they're all going to drop out next week. Maybe that's information you have that no one else has, and you could, you know, bet on that strategy. If you've determined that, you know, 3/4 of the people in your class are complete wasters, you know, maybe you're going to bet some money. Or maybe you figured out that you're in the brainiest possibility, that you're the best of all of the classes, you know, and you're going to have a pass rate of about like 90% or something. Now, the attendance rate is an interesting one. Attendance has been very good so far in this module for this class. In other classes, it's already starting to waver, you know, so that's interesting. So at the moment, all those are at 50%. Munster is trading at 42% chance of beating. Barça's 80% chance of beating Celtic. This is a strange one here. Why would you bet for one and not bet against the other? You know, what we'd probably get from this is, well, these prices might trade, you know, close to each other, but of course you have to account for the possibility of a draw as well, which would be the gap between the prices, perhaps. Okay, so you should have an email there telling you how to sign up, and you can work away. Again, it's totally voluntary, but I think it would be very, very interesting, a very interesting experiment, you know, and so you can trade as often as you like. So we'll see how it works now fairly soon, because obviously you won't be able to bet on Munster beating Racing, you know, after the match. So we'll see fairly soon how that works. So some people might make some money straight away, but other people just might make some money by buying and selling fairly quickly and turning their shares around, you know. I mean, if you were to buy one of these 50% ones now, you might be able to sell it for 60 like in a few days and just take your money now, irrespective of what happens. So you're predicting the final outcome, but you're also hazarding a guess as to what the market's going to do as well. Okay? Any questions? So it's a bit complicated in general, but I think this site does a very good job of making things a bit simpler, because you can just say whether you want to, bet or not. Okay? Whether you want to go up or down. Now, let me just show you there. You can also cash out. You can see your bobs there. Look, you can also cash out. So I have shares in this, and I spent that much for them. I could sell those. I could take my money out now. So it's like going back to Paddy Power and saying, can I trade this in now instead of waiting for the match to happen? And so what I could do is I could probably wait now a few days till this price goes up, and then sell my stuff at a profit. But in general, I'm not going to participate.
Can you do it on horses and stuff like that as well?
Just the questions I specified, So it'd be too well. Some sites allow the users to submit questions as well, but I'm not going to bother. Horses are too complicated anyway. There's too much maths.
I'm just thinking there, if the prices will always go, if it was a good horse, the prices will always go in there before the race goes on.
Yeah. The thing is though, there's nobody does that better than Paddy Power.
That's it. Yeah.
So why would I? We wouldn't even try that. So the sports ones are in there for you to try, see how it gets going, see how it works. So no, you've one pot of money and one set of questions. Do you know what I mean? If you make all your money off Dynamo Kiev, that's fine too. Do you know what I mean? You can bet it whenever you want, because I'm hoping you bet money on the questions I'm asking you. Also, if there's a good match coming up, like Ireland versus the Faroe Islands, it just didn't seem that interesting. So if there's some interesting matches coming up, you could email, or interesting questions, you could email to me and I could maybe put them in. I'll always try and have one or two non-coursey ones, but the ones that are in there now, just to kind of get you practice and see how it works if you want. Okay? Any other questions? So the cash out button is there in the in the dashboard. That's important. That's where you can take your money now if you want. So please do that if you're interested, and it could be interesting.